Well, kia ora ana tātou katoa, tēnā koutou katoa, welcome everyone. Happy New Year in person. I do want to say that it seems like a very long 12 months, and I'm very pleased to be on this side of the 12 months and good to see you all in fine health. We're here today to talk about our monetary policy statement that was released at 2 p.m. And as always, I'm supported by both members of our Monetary Policy Committee and also senior members of the Reserve Bank staff who are also on the Monetary Policy Committee. Christian Hawkesby and Yung Ha are with me and others are dotted around. First of all, the Monetary Policy Committee agreed to maintain the current stimulatory level of monetary settings in order to meet our consumer price inflation and employment remit. The committee will keep the official cash rate at 0.25% and the large-scale asset purchase program and the funding for lending program unchanged. Global economic activity has picked up since the November monetary policy statement, but we note that this lift in activity has been uneven both between countries and within countries, very sector specific. The initiation of global COVID-19 vaccination programs is positive for future health and economic activity. The committee agreed, however, that there does remain a significant period before widespread immunity is achieved. In the meantime, economic uncertainty will remain heightened, especially as international borders continue to remain closed and mobility restrictions remain. Economic activity has picked up over recent months in New Zealand, in line especially with the easing of the health-related social restrictions. Households and businesses have also benefited greatly from the significant fiscal and monetary policy support, bolstering their cash flows and spending. International prices for New Zealand's exports have also remained solid, supporting exporters' incomes, although some of this has been offset with the rise in the New Zealand dollar. Some temporary factors are supporting consumer price inflation and employment. These one-off factors include, in no particular order, higher oil prices, supply disruptions to trade constraints, due to trade constraints, the recent suite of fiscal stimulus, and considerable spending catch-up following the easing of the most severe social restrictions in New Zealand. The economic outlook ahead remains highly uncertain, determined in large part, of course, by the future health-related social restrictions. This ongoing uncertainty is expected to constrain business investment and household spending growth. The committee agreed that inflation and employment would likely remain below its remit targets over the medium term in the absence of prolonged monetary stimulus. The committee also agreed to maintain its current stimulatory monetary settings until it is confident that consumer price inflation will be sustained at the 2% per annum target midpoint and that employment is at or above the maximum sustainable level. Meeting these requirements will necessitate considerable time and, of course, patience. In finishing, the committee agreed that it does remain prepared to provide additional monetary stimulus if necessary, and we note that the operational work to enable the OCR to be taken negative is now completed. That ends the statement I wanted to make. Mai taki ma'ata, open to questions. Thank you.
The bank's been a lot more effective in lowering deposit interest rates than borrowing rates. Why do you think that is? Are you happy about it? And if you're not, is there anything you can do about it?
Yes, we've put in the record of our meeting a very clear message to banks that we are watching to see what their lending rates do. We're aware there's more than just one source than wholesale interest rates. There's the deposit rates, but also our funding for lending program provides that shadow opportunity for banks to continue to have a low cost of funding, and that is to be seen to be passed on. Our core interest is the interest rates that households and businesses face, and so we will be looking forward to continued pass-through of those rates.
Alexa Cook from TV3. I know you operate with a least regrets approach, but what responsibility do you take for the surge in house prices over the past year?
Yes, thank you. We've been very clear that monetary policy, interest rates in particular, and lower interest rates has a positive impact on asset prices. We're also very clear that one of the key assets that New Zealanders like to invest in are houses, and hence our monetary policy has put upward pressure on house prices. But I want to restate that our remit is low and stable consumer price inflation and maximum sustainable employment, and I'm very proud with the fact that we remain well in line for achieving that. I would refer all listeners, all readers and all interested parties to the information we shared with the Minister of Finance in December of last year, where it explained the very complex role of economic policy in general and monetary policy specifically around determining house prices, and the role which we have as a central bank, not just with monetary policy, but financial stability policy, where we are concerned around the high house prices, the impact that can have on financial stability and financial institutions' stability, and that is a large part why we increased our loan-to-value ratio requirements just recently.
Do you agree that removing LVRs was the biggest catalyst for a 19% rise in prices?
No, we have no causational work to suggest that is the case. Again, it's a multitude of factors, balance sheet, monetary policy in part, the interest rate, significant financial or fiscal policy. The balance sheets are very strong. We point to the fact that there were more New Zealanders in the country than usual, a significant number more. And of course lower interest rates and the impact on investing. So I think the LVRs, we are confident that around for the investor market, the LVRs will be biting, and if they aren't, we will continue to work until we are comfortable.
Hi, Brent Edwards from NBR. I think a number of economists had expected that you would kind of wave away the thought of negative interest rates, but you've still got it there in the statement. What are the worries that you have then about the economy that you don't feel confident enough that you can at least push that to one side?
I think it's really critical for people to understand that our growth and inflation forecasts are based on ongoing monetary stimulus and a significant level of that. We want to retain all optionality to provide more stimulus if it proves necessary. What might make that necessary? Continued health problems, ongoing longer than expected border restrictions, business confidence lagging and a lack of investment. There's a long list of things to worry about, and hence we want to retain the optionality, the full optionality of the suite of our tools to be prepared for any of those types of scenarios. And Brent, as you've wisely written many times, we've always talked about a negative or the capability of taking interest rates lower as an option that should be available to us, not an immediate expectation to have to use.
Thank you. Could I ask for your take on the global rise in bond yields and just ask how much of a challenge does that present for you in terms of setting policy and so forth?
Yes, thank you. I mean, we've been, and I'm going to pass on to Christian, actually, I'm very aware of the rise in global bond yields. They directly impact on funding costs in part for banks, which then pass on into retail lending rates. This is why we've opened up our funding for lending program to make sure there's more than just a wholesale channel for funding. Underlying it, we are pleased that there are positive reasons for rising bond yields, that is rising growth expectations, rising inflation expectations from historically low levels. I've answered everything that Christian was probably going to say.
Well, I mean, there are those factors at play there are a number of factors that are driving long-term interest rates, the domestic and global outlook for inflation and growth. And as the Governor mentioned, some of that has been good news since November. We're conscious that we can't completely stand in the way of that. We have our LSAT program where we are having a downward influence on yields from our actions from those programs. But we are still conscious that we do want to see price signals from the yield curve. We want to be a downward influence and supporting the market functioning, and the market's functioning well at the moment.
Okay. And just one further question. I wondered if you gave any consideration to giving more explicit forward guidance, for example, a date or a time frame for how long you would remain at these stimulatory settings, as other central banks have done. So why did you choose not to be more specific on that?
Yeah, I mean, that is a great question, thanks. And yes, we talked a lot about it. The committee agreed that there is no specific date that we believe confidence will magically arise where we believe that inflation is going to be, sustainably at the midpoint or employment near or above maximum sustainable employment. So we became more state dependent, but we wanted to provide it very clear that we believe it's going to take some time to get that confidence. We're going to have to see these outcomes and understand the drivers.
Giles Beckford, Radio New Zealand. I note that you say you'll stay with the bond buying program until June next year, 100 billion limit. Could you give us a flavour of perhaps the conditions that might trigger you to reconsider that and sort of a time scale? Because clearly bond issuance is declining given the fiscal forecast we've had from government, and the economy is obviously on a recovery path, albeit it may well be lumpy by your view.
Yes, thank you. I do hope that the economy remains, continues on a recovery path, as you say. I think the number one determinant of our bond buying activity will be our view on the monetary settings needed to achieve our remit. At the moment, we see our monetary settings as consistent with achieving it, hence the bond buying program will continue. When monetary conditions may need to change sometime in the future, it's at that point we will reflect on all of our instruments again and against the principles we've been very clear with the team around effectiveness, efficiency, balance sheet impact, etc., and decide which of our instruments we would need to move to alter the conditions as desired. So, we're back to the full suite of options and we will watch, worry and wait as the data comes. The 100 billion, I just want to remind people, it's a limit, it's not a target, and we also have the 60% of the total bond market side there. So it's great to know that we've got all of our other tools at the ready as well.
Sorry, back to housing. Do you regret removing LVRs?
No, our decision at the time was based on the information at the time, and really a key part of that decision was not just where we were and what we knew, or more importantly, didn't know about the economic impact of the COVID crisis, but it was about all of the other government policies and Reserve Bank policies, how the LVRs would impact with them. If on the one hand you are trying to maximise cash and credit availability to businesses and households, and at the other time constraining it yourself through an LVR, we didn't believe that made sense there and then, and hence we got one hand out of the way to maximise the effectiveness of the others, and we are now back to where we need it.
And lastly, banks loaned $9.6 billion to home buyers in December. What do you make of that number?
A very strong demand for housing in New Zealand. I don't say that tritely. I would say that I would also note a very strong desire and willingness to build houses in New Zealand as well. So housing consents are at record highs. A lot of the initial demand surge we've seen for housing is past its peak. Supply will continue. The LVRs are back on, in particular for investors. And so I would be far more cautionary as someone thinking that there is a one-sided bet or a free lunch when it comes to investing in houses. That is far from the case. And so watch this space.
Governor, in the last week or two, the Federal Reserve and the Reserve Bank of Australia have talked about wanting inflation to be significantly above 2% for a bit of a time to ensure that average inflation over the long run is there, to get some real escape velocity. I see from the forecasts, 5.1, you're still only barely above 2% towards the end of the forecast period. And that 5.3, you've actually assumed a tighter, unconstrained OCR track. Are you stimulating enough?
Yeah, I suppose I probably, the good news, Bernard, is that these are scenarios which may well turn out to be wrong. The bad news is these are scenarios which may turn out to be wrong. But you are very correct to ask, have we got sufficient stimulus in place? I would say an additional question that we are really concerned is, we are comfortable with our monetary settings. Are we going to be sufficiently patient to make sure that we really do embed the growth, the employment and the consumer price inflation that is consistent with our remit? And so it's that patience and courage that we need to be able to display to get there that matters most for us.
And as mentioned earlier, the bond yields have jumped up in the last week or so all around the world, but here too, back to pre-COVID levels, and the currency's up over 73. Are you concerned that either of those things are effectively tightening conditions more than you'd like?
With those, this is exactly why we differentiate the monetary settings, what we can influence and what we will do and how we will stay there, and then broader monetary conditions. It's the latter that will determine whether we're successful or not. And if the conditions tightened, unnecessarily for our points, then we will alter our settings. We have the control to do that. Likewise, with all of the fantastic work that Christian and Jung's teams have been doing, we are no longer reliant purely on wholesale funding. We have our funding for lending program, we have local deposits going on there. So, we have a lot more optionality to achieve the conditions necessary or sustain the conditions necessary to meet our remit.
Does that mean that Sorry for the follow-up. Does that mean, with no change to your FLP, the LSAP or the OCR, that you're accepting the higher bond yields and the higher currency, and therefore wouldn't push back down against them?
No. What I said was that if we thought monetary conditions became inconsistent with what we need, we are prepared to move. What we've talked about very openly there is we expect more pass-through from the banks because of our funding for lending program. They can't just point to the rising wholesale interest rate to explain why they are not passing through the rates. They can come to us around that lending program. So that's very clear to them. And of course, as I mentioned before, the official cash rate can go lower.
Do you accept the proposition that negative real returns for depositors might be contributing to upward pressure on house prices? And is it wise for the Reserve Bank to be reinforcing the message that saving is a mug's game?
I think that last statement was yours. We've never reinforced that message, and I think that's quite foolish to say that. Investing and investing smart is exactly what people need to do. What I note from your question really reflects a big challenge that New Zealand has. Whenever people tend to think about investing, they tend to think about the house. There are more options for investing that have similar risk and return and probably have more longer-term productive implications. So house prices, like any asset, can under and overshoot fair value. And we will be very clear around when we think house prices are creating financial stability risks, and we are ready to act as proven with our recent loan-to-value ratio points. What you were saying, of course, though, is basic economics, where when interest rates are low, people may look further along the risk-return curve for higher returns if they feel they need that. But they have to understand that they're not just moving along the return curve, they're moving along the risk curve as well, the risk-return curve. And we're saying, do that with eyes wide open.
But isn't part of our problem that, for example, that the share market is relatively small, intercepts relatively little of the economic activity of the country. So the options available for someone looking for a positive return are fewer.
That's if you want to constrain yourself to New Zealand share market or just listed equities.
Thomas Coughlin, Stuff. To Brian's point, are you concerned about the rise of small-scale retail investors and platforms like Sharesies, people who are potentially driven out of the housing market and looking to make a quick buck with relatively small amounts of money because of the current conditions?
We're hugely encouraging of financial innovation and financial inclusion. So this is, a natural case of, I would say, capital markets being more accessible and starting to grow through generations. Having said that, you have to be incredibly cautious about people entering markets thinking that there is a one-side win in there. And so this is why we're saying when you're moving into other investments, by the way, housing is just as risky. People just tend not to think about that. There are many challenges to housing, keeping your tenants, meeting all of the requirements that you have as a landlord. The share markets, equity markets and other forms of investment have their relative returns and have their relative risks as well. Global equity markets, the number one question going on there is similar to the number one question here around housing. Global equity markets are increasingly being talked about. Are they overvalued? Is this a function of low nominal interest rates for stable? So that is the world we live in. There is no free lunch.
Tom Palastraka from Stuff. David Seymour said that the statement today shows that you clearly don't share the government's confidence in the economy, and also, he's saying that the relatively high weight you're putting on economic uncertainty related to future health-related social restrictions is also an indictment of its policy, of its approach at the border and what's happened at the border. Does he have a point?
I think the main issue you need to take from us is the number one uncertainty is global. It is a global health crisis, and we are talking about global travel restrictions, global trade restrictions, global social mobility restrictions. This is not a New Zealand specific issue. It is an issue that the New Zealand economy and the context within which it operates. That is our point around what we're doing. I do note that we have been probably one of the most socially free nations over the last 12 months, and that has been one of the single biggest impetuses to economic activity we've seen here in Aotearoa, New Zealand.
And just a sort of non-MPS related question, so we can handle that separately if that's better, but there seems to be suggestions that a ransomware gang is starting to auction off data that was obtained as a result of the Acceleron breach. Do you have any information on that, or any concerns that the same thing is about to happen to the data that was taken from the Reserve Bank?
Yeah. Good question. And look, I apologise, but I'm just going to have to say we have no comment on that. I mean, we're talking about the cyber breach that we were a victim of. I want to state again my great sympathy for those people whose data was impacted. The good news is all of the institutions who were impacted are now well aware of it and are working with us very constructively. There is an end to this current challenge, but I don't want to talk about the actual ongoing investigations and activity that is going on, because that would potentially compromise and jeopardise success in that space. Apologies for that, Tom.
Janae Tibshirani from interest.co.nz. Just wondering what advice you might have for the government around how its policy perhaps needs to either change or stay the same, given the fact that we'll have prolonged monetary stimulus.
Jung, you've been very quiet.
Well, we note that for the next 3 to 4 years anyway, fiscal policy is a big supporter of the recovery. I mean, 2020 primarily through the wage subsidy, but actually for the next 3 to 4 years we expect ongoing fiscal spending supporting the recovery. But yeah, over and above that, we're just basically taking Treasury assumptions about the path of fiscal spending.
I was sort of referring to any of the side effects that loose monetary policy can have, particularly on wealth inequality. I know this is an area that the Reserve Bank's doing work, but how conscious should the government be of the side effects of this?
From everything I've heard, which is largely coming through from the people here doing excellent work as journalists, the government is acutely aware of the challenges that both this COVID crisis has impacted on economic well-being, the uneven nature of it through both demographics and geographically of the activity. And also we're acutely aware of what low nominal interest rates can mean through time, both positives around income equality, employment and welfare, but also it's not even across all groups. And so, fiscal policy, targeted fiscal policy, housing supply activity, these are all critical activities that don't suddenly get turned on overnight, but you need to see ongoing action and activity in those spaces.
Are you satisfied with the uptake of the funding for lending program, and have you done any work to see the flow through of the funds that are being picked up and where they're actually ending up from the banks?
Yeah, great. Thank you, Christian.
Yeah, so the funding for lending program is operating as we expected. There's been very modest take-up at this point, and that's what we expected to happen. It's a scheme where the main channel is giving banks confidence to lower their other funding costs and pass that on through into lower lending rates, and we're seeing that happen as well. In terms of take-up of the scheme and more scale, we're expecting that to happen further along in the window that the scheme is open, and that's what we've observed internationally as well. So far, so good. We're very happy with how it's performing.
The mere fact it's in the room changes behaviours, and that's what we will be watching.
Just on that issue of whether the banks are passing on these lower funding costs, I see from figure 3.4 that mortgage rates are down about 100 basis points from the easing early last year, but term deposit rates are down 150 basis points, which seems to suggest that the banks are pocketing some of that lower funding costs and higher margins. And I'm curious, are you happy with the way the banks are passing on those lower funding costs, particularly to business borrowers? Because I'm curious as to whether they are also seeing the benefits of those lower funding costs.
Yeah, great questions again. I think, stepping it back, first and foremost, we want to influence the prices that banks on lend to households and businesses, and we want to see those prices fully reflected from the monetary easing. And so we believe there is more to do. To the extent that banks may be concerned or not concerned about the pace of lending as opposed to the margin of lending, that is fully in their control, and they fully control the risk of the bank, i.e. who they lend to. But we believe there is more work to be done around passing on the interest rate costs or the benefits.
In any particular area, housing or business?
I'd say across the board, and just a bit on the business. It was a little bit. There was thinking as well. It's about leading the horse to the water and getting the horse to drink. A lot of the challenge that banks have had over the last 10 months or so was certainly initially, yes, we can provide cash flow, credit, low interest rates, but we can't force people to take those up. Households, particularly investors, have been incredibly willing to take it up for housing, but businesses have been far more cautious. And, this is in part what gives us that uncertainty around the sustainability we want to see in growth. So we want to see a lot more business confidence, which would be reflected in part by business borrowing.
Just one final one from me on the long-term outlook for interest rates and how long you can allow these historically low mortgage rates and interest rates, around 2.5% for mortgage rates. How long can you leave them there before people embed them in their minds and in their financial plans in a way that means it's really hard to get them up again?
Our core concern is the thing that we can most influence is the fear of having low inflation expectations below the midpoint of our target range or even below the range itself being embedded. We can always change the level of interest rates, but we can't directly change people's inflation expectations. This is why we are prepared to really give it the benefit of doubt, to show that patience and continue with the stimulatory monetary conditions until we see the underlying inflation expectations really aggregated and building through to something sustainable. The number one lesson from the last crisis, the most recent crisis, is never the last crisis, is people moving too quickly to restore normal monetary conditions. We don't know what normal actually means, that's only ever assumed, and we are in no rush to do that because we don't want to get in the way of inflation expectations being anchored at our midpoint.
Praveen Menon from Reuters. You spoke about that you would like to get to or about the maximum sustainable employment level. So is there, how low would the employment rate have to go to sort of meet that target? Is there a level?
It's going to be knowing it when you see it type issue, and as you're aware, we have used a very broad range, I'll come across, of indicators of what we believe is labour market capacity when we are saying, look, we think we're around maximum sustainable employment. At the moment, we believe we are below maximum sustainable employment and unemployment is higher. There are other indicators, Jung, around.
Yeah, we've got a chart in the chapter 2 of the document that sort of lays out the sort of the many dimensions of the labour market as we think of it. It's not, you can't boil the concept of maximum sustainable employment down to one number, even though we like to talk about the headline unemployment rate. So if you work your way through those dimensions, it sort of shows that, relative to where we were pre-COVID, a lot of those indicators are still, south of what we would term its sort of maximum sustainable level. So that gives us a sense that the labour market has deteriorated, not by as much as we had initially feared, but it is still south of a concept of maximum sustainable employment.
Yeah, we've been really positively encouraged by large sections of the labour market, particularly construction activity, very strong. Likewise, there are pockets of jobs which have just stopped as long as international borders remain closed. And so it comes down to either the borders and or the ability to reallocate that labour effort to where the jobs, where the demand for employment is. So we'll keep watching that, but we are confident that we are below the maximum sustainable employment level at present. Wonderful. Any last exciting question? Another house one? Thank you very much. All the very best.